Does your chart ever look like this? Like, really? What do you make out of this chart? Any analysis? This is sheer noise. Nonsense. Why using more indicators makes you a worse trader? Most traders don't lose money because they don't use indicators. They lose money because they use too many indicators. And most of those indicators are saying the same thing. If your chart is filled with lines, oscillators, and signals, that's not clarity, that's noise. Today, I want to simplify indicators in a way most traders never learn. By understanding what indicators measure and why the right combination matters more than the number you use. Indicators do not predict markets. Every indicator is derived ultimately from the price. They are measurements. And if you measure the same thing multiple times over and over again, you do not get better insights. You get repetition, confusion, noise. So the real question is not which indicator is best. The real question is which part of price behavior is this indicator measuring? All indicators measure different dimensions of price. Multiple indicators from same category equals to redundancy, something that I just explained. Optimal trading uses complementary indicators and not supplementary indicators. Indicators that can be replaced one by the other, both of them, all of them are not really required. All indicators fall into just five categories. They measure five dimensions of price: trend, momentum, volatility, volume, and market structure. Once you understand this, indicator selection becomes simple. First, trend indicators. They tell you whether the market is trending and in which direction. Examples include moving averages, whether it is SMA, EMA, DMA, ADX, which is average direction index, super trend, Ichimoku clouds. Here is the key point. Using multiple trend indicators does not increase accuracy, it increases false confidence. One good trend indicator is enough. Trend answers one question: is the market up, down, or sideways? Moving on. Next is momentum indicators. Momentum measures the strength of a move. Examples include RSI, MACD, stochastics, CCI, ROC. Momentum often weakens before price reverses. That's why divergences work. But using RSI, MACD, and stochastic together is just measuring momentum three times. One momentum indicator is enough. Third is volatility indicators. Volatility tells you how much price is expanding or contracting. Examples include Bollinger Bands, ATR, that is average true range, Keltner channels, Donchian channels, there are many more. Volatility does not tell you direction, it does not tell you trend, it tells you when to trade. Low volatility leads to expansion, high volatility leads to consolidation. This category is powerful and often ignored. Moving on, the fourth category is volume indicators. Volume tells you whether money is supporting the move. Examples include volume, VWAP, OBV, which is on balance volume, volume profile, accumulation, and distribution. Price can move without volume, but it cannot sustain without volume. This is why low volume breakouts often fail. Finally, the fifth category, which is the market structure. This is raw price behavior, support and resistance, trend lines, whether they are diagonal, horizontal, channels, Fibonacci retracements or extensions, supply and demand zones, simple market structures of higher high, higher low. Everything else is derived from this. Structure leads, indicators follow. So, what does a clean trading setup look like? Very simple, one indicator from each category. For example, I've put together a set for you here. Say, for example, we use EMA, a 50 EMA, to figure out trend. If the price is trading above 50 EMA, it is likely an uptrend. If the price is trading below 50 EMA, it is likely a downtrend. Could be analyzed this way. Similarly, for momentum, we could use MACD, stochastic. I've put up RSI as an example. For volatility, we could use average to range. For volume, we could use VWAP or simple volume bars. For market structure, of course, support, resistance. Each tool answers a different question. Different questions create clarity. Same questions repeated create confusion. Common mistakes to avoid. The biggest mistake traders make is stacking indicators from the same category. Some examples I've put together on the screen. I'm sure you understand it by now. If you have RSI, MACD, stochastic all plotted on your screen, pointless, they're all indicating momentum. Overall, it this kind of repetition just leads to false confidence and not accuracy. More indicators do not mean better trade. Let me leave you with this thought. Indicators don't fail, context fails. Price leads, structure decides, indicators confirm. If you think in dimensions, not signals, your trading becomes simpler and more consistent. If this video helped, subscribe to the channel. This is not about predictions, this is about understanding how markets actually work. If you guys like the content, check out my one on one mentorship program at tradingbyprateek.com. I'll see you guys next time.